Hey, are you tired of seeing your savings account barely grow? Do you want to build real lasting wealth? Well, in this video, I'm going to show you exactly how to do that by building a rock-solid ETF portfolio in just 7 easy steps. We'll cover everything from defining your investment goals to choosing the right ETFs and maximizing your returns. By the end of this video, you'll have the knowledge and confidence to start investing like a pro. Before you even think about picking an ETF, you need to ask yourself, what am I investing for? This is the foundational question that will guide all your investment decisions. Without a clear purpose, your investment strategy can become unfocused and ineffective. Are you saving for a down payment on a house in 5 years? This is a common goal for many young families and individuals. Knowing this will help you choose investments that are relatively stable and less volatile, ensuring that your money is there when you need it. Planning for early retirement in a couple of decades? If so, you might be willing to take on more risk for the potential of higher returns. This long-term goal allows you to ride out market fluctuations and benefit from compound growth over time, or maybe you just want to grow your wealth over the long term. This is a broad goal that can encompass various strategies, from investing in high-growth stocks to diversifying across different asset classes. The key is to stay committed and regularly review your portfolio. Clearly defining your goals will determine your investment timeline and how much risk you're comfortable taking. For instance, if you have a short-term goal, you might prefer low-risk investments like bonds or money market funds. On the other hand, long-term goals can afford to take on more risk with equities or real estate. For example, a shorter time horizon might mean a more conservative approach, while a longer time horizon could allow for more aggressive investments. Understanding your risk tolerance is crucial because it will help you stay the course during market downturns and avoid panic selling. Remember, investing without clear goals is like driving without a destination. You might end up somewhere, but it probably won't be where you wanted to go. Setting specific, measurable, achievable, relevant, and time-bound SMART goals can provide a roadmap for your investment journey. This way you can track your progress and make adjustments as needed, ensuring that you stay on the path to achieving your financial dreams. Now that you know what you're aiming for, it's time to figure out your asset allocation. This is a crucial step in your investment journey, as it determines how your money will be distributed across various types of investments. Asset allocation simply means deciding how much of your portfolio you want in different asset classes like stocks, bonds, and real estate. Each of these asset classes has its own risk and return characteristics, and the right mix can help you achieve your financial goals. Stocks are generally considered higher risk, but offer the potential for higher returns. They represent ownership in a company and can provide significant growth over time. On the other hand, bonds are typically seen as lower risk, but with lower potential returns. Bonds are essentially loans to a company or government, and they pay interest over time. Your ideal asset allocation depends on 2 main factors: your risk tolerance and your investment time horizon. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Your time horizon is the amount of time you expect to hold your investments before you need to access the money. A younger investor with a longer time horizon might be more comfortable with a higher percentage of stocks. This is because they have more time to ride out the ups and downs of the stock market and can potentially benefit from the higher returns that stocks can offer over the long term. Conversely, someone closer to retirement might prefer a more conservative approach with a larger bond allocation. As they approach the time when they will need to start withdrawing money from their investments, they may prioritize preserving their capital over seeking high returns. Remember, there's no one-size-fits-all answer here. Each investor's situation is unique, and what works for one person might not be suitable for another. It's important to consider your own financial goals, risk tolerance, and time horizon when determining your asset allocation. It's all about finding the right balance for you. This balance will help you manage risk while still working towards your financial goals. Regularly reviewing and adjusting your asset allocation as your circumstances change can help ensure that your investment strategy remains aligned with your objectives. Now comes the fun part: choosing the actual ETFs for your portfolio. This is where your research and understanding of the market come into play. It's not just about picking any ETF that looks good. It's about making informed decisions that align with your financial goals and risk tolerance. But with thousands of ETFs out there, how do you pick the right ones? The sheer number of options can be overwhelming, but don't worry. By following a systematic approach, you can narrow down your choices and find the ETFs that best suit your needs. First, make sure the ETFs align with your chosen asset allocation. Asset allocation is the process of dividing your investment portfolio among different asset categories such as stocks, bonds, and cash. This strategy helps manage risk and can improve returns over time. If you want 70% stocks and 30% bonds, your ETF choices should reflect that. This means selecting ETFs that represent these asset classes in the proportions that match your allocation strategy. It's crucial to stick to your plan to maintain the balance and risk level you are comfortable with. Next, look for ETFs with low expense ratios. The expense ratio is the annual fee that all funds or ETFs charge their shareholders. It is expressed as a percentage of the fund's average assets under management. Lower expense ratios mean more of your money is working for you rather than being eaten up by fees. These are the annual fees charged by the fund, and they can eat into your returns over time. Even a seemingly small difference in expense ratios can have a significant impact on your investment returns over the long term. Therefore, it's wise to compare the expense ratios of similar ETFs and choose the ones with the lowest fees. Also, consider the ETF's tracking index and its historical performance. The tracking index is the benchmark that the ETF aims to replicate. Understanding how well the ETF has tracked its index in the past can give you insights into its potential future performance. Has it consistently tracked its benchmark index? Consistency is key here. An ETF that closely follows its benchmark is likely to provide more predictable returns. Look for any significant deviations from the benchmark, as these could indicate potential issues with the ETF's management or strategy. How has it performed in different market conditions? Evaluating an ETF's performance during various market cycles, such as bull and bear markets, can help you understand its resilience and risk level. This information is crucial for making informed investment decisions, especially if you are concerned about market volatility. Finally, don't be afraid to diversify within asset classes. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. By spreading your investments across different sectors and industries, you can reduce the impact of any single investment's poor performance on your overall portfolio. For example, instead of investing in just one S&P 500 ETF, consider adding ETFs that track different sectors like technology, healthcare, or emerging markets. This approach not only provides exposure to various growth opportunities but also helps mitigate risks associated with any single sector. By carefully selecting and diversifying your ETFs, you can build a robust and resilient investment portfolio that aligns with your financial goals. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, "Don't put all your eggs in one basket." Well, that applies to investing too. Diversification is crucial for managing risk in your portfolio. It means spreading your investments across different asset classes, sectors, and even geographical regions. By diversifying, you're essentially reducing the impact of any single investment on your overall portfolio. Think of it like this: if one stock in your portfolio plummets, it hurts. But it won't be catastrophic if the rest of your portfolio is performing well. Diversification is your best defense against unexpected market downturns and helps ensure smoother returns over the long run. Monitor your portfolio. Don't just set it and forget it. Building an ETF portfolio isn't a set it and forget it kind of deal. You need to regularly monitor its performance to ensure it's still on track to meet your goals. How often you monitor your portfolio depends on your preferences, but quarterly or semi-annually is a good starting point. When reviewing your portfolio, check how your individual ETFs are performing, if your asset allocation has drifted, and whether any adjustments are needed. Remember, market conditions change, and your investment strategy might need to adapt accordingly. Rebalancing. Keeping your portfolio in check. As you monitor your portfolio, you'll likely notice that your asset allocation drifts over time. This is because some investments will perform better than others, causing your initial asset allocation to shift. That's where rebalancing comes in. Rebalancing involves selling some of your winners and reinvesting the proceeds into your underperforming assets to bring your portfolio back to your desired asset allocation. Think of it like trimming a hedge. You're trimming the overgrown areas and letting the weaker areas catch up to maintain a balanced and healthy portfolio. Stay the course patience is key in investing. The stock market is like a roller coaster. There will be ups and downs along the way. The biggest mistake investors make is letting their emotions dictate their decisions. They panic sell during market downturns, locking in losses, and miss out on potential gains when the market recovers. Remember, investing is a long-term game. Don't get spooked by short-term market fluctuations. Stick to your plan, ride out the volatility, and focus on the long-term growth potential of your portfolio. Patience and discipline are key to achieving your financial goals. And there you have it, 7 simple steps to building a powerful ETF portfolio. Remember, investing doesn't have to be complicated or intimidating. By following these steps, you can take control of your finances and build a brighter financial future for yourself. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more investing tips and strategies. Until next time, keep crushing it. Check out these recommended videos for more investment knowledge to help grow your wealth.